1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the, anyone? The Great Depression, passed the, anyone? The tariff bill, the Hawley-Smoot Tariff Act, which anyone raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression.
Hello and welcome, everybody. I'm Vernon Cushenberry, your Chief Investment Officer, and I'm back with another quarterly market update, and I just couldn't resist it. That little clip is the totality of the knowledge base that many in my generation have about tariffs up to this point, so I thought it was worth a cold open. But let's get into it, because the recent tariff announcement by President Trump's administration has caused a pretty significant sell-off in the markets. Markets are down 9% just in the last couple of days and off 16% from their highs. So I want to dive into tariffs. I want to give you a little bit of perspective, a lens by which to think about these. We sent a message out to our clients last week with some high-order talking points. So I'm going to review those and hopefully just add a little bit of perspective to this conversation. But what are we dealing with here? Liberation Day, as President Trump labeled it, announced new tariffs across the board. All of our trading partners were levied with new tariffs. Tariffs are effectively a tax on imports. They raise prices for consumers and shift production domestically, or at least that's the goal. Now, President Trump argues that these are reciprocal and strategic, meant to level the playing field, bring jobs home, strengthen the dollar, reduce trade. The idea is that it will cause some short-term pain, that's acknowledged, but that will be in exchange for long-term gain, and they're easily reversible if deals are struck. Now, critics say these broad tariffs reduce growth, raise costs, invite retaliation, and disrupt global supply chains. And I think we're probably in a little bit of a short-term, long-term dichotomy here. In the short term, last week's reaction, the markets were very volatile. The dollar weakened. There was a rotation into gold and a rotation into treasury, which led to a decline in interest rates. And the longer term outlook depends more on policy outcomes. So if this is successful, it will lead to more domestic production, a stronger US dollar, and a manufacturing revival. If it fails, it'll lead to a prolonged trade war, inflation, and economic drag. The longer it lasts, the higher the likelihood of failure. If President Trump, who wrote The Art of the Deal, is using this announcement as a negotiation strategy to bring some of that international production home, then the likelihood that these are successful is higher. Now, our view on the whole thing is stay diversified, as always, stay disciplined, focus on long-term over the short-term, and let's look at what that long-term really means. So the markets have sold off in the last few days, but when we zoom out here, going back almost 30 years, we can see a pretty healthy rise in the markets. And when we contextualize that and we ask ourselves, well, how expensive and or cheap are the markets? They had been bumping up against expensive territory for the last few quarters. And I've noted this in prior calls. Well, this recent sellback has, you might think, right-sized the market a little bit, but they're not yet at their long-term average. They're still on the expensive side of things. So while we've been working with investors to deploy cash here because prices are cheaper, we keep these valuations in perspective. I love this chart. I need to come back to it at least once a year. It's a perspective chart. It looks at the last, returns going back to 1980 here, and these are S&P 500. So every year since 1980. Let me pull out my little marking pen here, and what you can see if you go back to 1980 was that the return for that year was 26%. That's pretty darn healthy. I think we would take that in any year. But intra-year, intra-year means that at some point during 1980, there was a 17% decline. And we all know what that feels like after last week. 17% decline. It hurts. We get calls from our clients. They want to know what's going on. Well, this is what's going on. It goes on every year. There's some geopolitical event, some tariff or similar tariff announcement that causes the markets anxiety. And when investors are uncertain about their future, they hit the sell button. And those actions manifest on this chart in all these little red dots. And you can look from 1980 all the way up to year to date. Most of the time, the annual return is on the right side of the zero line, meaning most of those returns, most of those gray bars are positive. But intra-year, peak to trough, all of these red dots show that, on average, there's somewhere in the neighborhood of a 10 to 20% decline in the middle of that year. And that's what we're in right now. And that is always cause to ask questions, but it's rarely cause for alarm. Moving on, again, back to that big picture, it's rarely cause for alarm because, as you can see on this chart, the S&P 500, which we're looking at again here, has a tendency over the long run to move up and to the right. And that's despite of major geopolitical events like the pandemic and the financial crisis and Black Monday and the stagflation of the 1970s and even the Great Depression. So that's important. And that's the picture that investors have a tendency to lose sight of when we go home and watch the news at night. And I'm guilty. I feel it. My heart rate starts to go up, my blood pressure starts to go up, and I have to revisit some of these slides and remind myself that, okay, this is what markets do. We experience the volatility in the midst of those long-term gains. Back to tariffs here on this slide. This was data released by the White House that shows the reciprocal tariffs. Many have argued that certain factors make these, maybe not so reciprocal because there are adjustments for various VAT taxes and unfair trade policies. But this was put out by the White House, this data, and it shows the blue bars here, the discounted reciprocal tariffs, and then the red bars, the tariffs on U.S. goods. So red equals what other countries assess on our goods and services. Blue equals what we are assessing on other countries' goods and services. So these are as high as we've seen since that Smoot-Hawley, really even higher, that Professor Ben Stein was talking about in that cold open. Now, I wanted to share this chart. I'm hearing a lot of social media chatter about this being some grand plan to start with a shocking tariff announcement that's higher than what you really want it to be long term, renegotiate, bring those tariffs down over time, and the reduction in those tariffs will be interpreted as positive news by the markets. Maybe. One of the effects of that is that it will it'll cause the market to sell off. That's happened. That's a certainty at this point. And in so doing, capital flows around the world will move from equities into bonds as the demand for bonds go up, which is what happens when you move cash from equities to bond. Interest rates, which are inversely related to price, they come down. And that's exactly what we've seen. So as the price on federal debt, the interest rate on federal debt comes down from 4% to 3.5% to potentially 3 to 2.5%, it makes it cheaper for the United States government to borrow. And what we're observing on this chart is nearly $7 trillion worth of our outstanding debt, about 30%, coming due this year. So when that comes due, we either have to pay it off, which means we have to come up with $7 trillion, which we don't have, or we have to refinance it, just like you would a home loan. You go borrow from somebody else willing to lend you the money, and we do that in the publicly traded markets, and we refinance that debt. Well, it's much more advantageous if we can refinance that debt at lower interest rates than it is if interest rates are as high as where they've been for the last year. And this is where the grand plan chatter comes from on social media. I can't speak to its accuracy, but if there were a grand plan, this might be how you would go about executing it. I know for certain you couldn't announce to the world that's what you were doing in advance, or it would lose its effect. So I wanted to share some of that rollover. This is a big deal. We do have a lot of debt to contend with in the United States, and it's all wrapped up in a trade deficit that's extended back nearly 30 years now. Part of my thinking on just the whole notion of tariffs is that over the long term, I agree with the economists that they're probably a drag. They're a tax, and a free trade world is better than a non-free trade world. But I also agree that policy is like a pendulum. It swings too far in one direction, then it corrects, and that tariffs have a use case periodically. And that's as far as I'm going to go on the political realm, and we're going to have to take a wait and see approach. As we do take a wait and see approach, we're doing our jobs, scouring the global markets for opportunities to rebalance and redeploy funds based on markets, sectors, and different aspects of the economy that look attractive. So when we get volatility, we see different sectors looking attractive. And I've touched on this chart in the last year. This is the international price to earnings discount versus the US. When you look at international markets, they've appeared cheap relative to the United States for a long time. Here's their average. They're on average cheaper than US markets, and they're on average cheaper by about 18%. And that's for a lot of reasons. The United States has the most efficient, the most sophisticated, the best and most well-regulated market in the world, and that's deserving of a premium. So international markets typically trade at about an 18% discount on average. Well, since 2017, that discount has been increasing significantly. And it got down here to about a 2 standard deviation below its long-term average. And this most recent tariff announcement has caused a little adjustment to that number. And a well-diversified portfolio, domestically and internationally, stands to benefit from that. And that's our job as portfolio managers and analysts to watch out for some of those opportunities and/or dislocations. Shifting gears on you again, I want to give most of its due time to perspective, because these events are typically all about perspective. And I like this chart here because it looks at geopolitical sell-offs of the past. They're typically short-lived. The gold bar here shows market declines in the geopolitical event, 1962 Cuban Missile Crisis. And then the first bar shows 6 months later. And the second bar shows 1 year later. So the Cuban Missile Crisis was a pretty good time to invest. 6 months later, the markets were up 21%. A year later, the markets were up 26%. And with a few lone exceptions, most of these crises have also presented good times to invest. You see the market generally bounces back. Okay, here's a look at bear markets going back to 1980. The bear market here is represented in gold. They're short and brief. They can be pronounced, meaning they can be down 10, 20, 30%, but they're short. There's not much gold on this chart. The market has a tendency to bounce back pretty quick. On average, a bear market will last 282 days, and it'll be down about 30%. So that's less than a year. It's protracted, yes, but it's short. And then we get that bull market, and that's what careful study of the markets tells us. And if you can keep that in perspective, you're going to be doing about as good of a service to yourself as you possibly can. And then lastly, the temptation, which I want to combat a little bit. I want to push back on this temptation a little bit because it can be costly. This is one of the most common investing mistakes, is to move to cash. The market's already sold off. If you move to cash after a sell-off, you're risking that reflexive response that can come with just a little bit of good news. And that's usually on account of investors getting too pessimistic. So this chart shows investors what happens if you move to cash. So moving to cash really pays off. If you spend 3 months in cash, there's a 74% probability of underperforming a 60-40 portfolio. If you spend 6 months in cash, there's a 71% probability of underperformance. And if you spend 12 months in cash, that probability goes up to 87%. So it feels like the right thing to do. It feels like the healthy thing to do. It feels like the safe thing to do. but the data do not support the decision. So I'm very, very hopeful that all of that gives you some perspective this quarter. I am here to answer your questions. I am here to field topics that you would like me to cover in the future. Reach out to me directly. I look forward to hearing from you. And until then, I will be back next quarter with another update. Thanks again.